Hey everyone, this is Larry Bammer with your weekly market update for December 19th. I'm trying a little different format, so it's a little bit longer than my short and sweet. Let me know how you think. Today, I want to walk you through what's happening with inflation, the job market, housing, and mortgage rates in simple terms so you can confidently explain the market to your buyers and sellers without getting lost in headlines or technical language. Let's start with inflation because it's still one of the biggest factors influencing mortgage rates. Due to the government shutdown earlier this fall, some of the key economic data was delayed. When that data finally was released, it showed inflation cooling more than expected. The Consumer Price Index, or CPI, showed prices rising only modestly month over month, with annual inflation easing to 2.7%, down from 3% the prior report. Even more important, core inflation, which excludes food and energy, dropped from 3% to 2.6%, the lowest level we've seen since 2021. That tells us that inflation pressures are continuing to ease across the economy, not just in one isolated area. One of the biggest contributors to inflation over the past few years has been housing and shelter costs, and those came in cooler as well. That helped keep the overall inflation in check and an encouraging sign for longer term affordability. The CPI report also marked the last major top tier economic report of the year when it comes to potential impact on mortgage rates. That doesn't mean that rates won't move now, between now and January. They absolutely can. But what it does mean is that we're less likely to see some big data driven moves until new economic reports start coming out in the new year. Now, let's talk about the job market because it's the other half of what the Federal Reserve's decision making process. Payrolls declined by 105,000 jobs in October, followed by a modest rebound in November of 64,000 jobs added, slightly above expectations. While that rebound helped, the broader trend still shows the labor market is cooling. The unemployment rate rose from 4 to 4.6%, the highest level since 2021, and it has been steadily climbing from 4.1% back in July. Another important detail is the type of jobs being added. Nearly 1 million full time jobs were lost, while more than 1 million part time jobs were added. That shift suggests households are becoming more cautious and relying more on part time income, which often leads to slower decision making when it comes to large purchases like buying a home. For the Federal Reserve, this creates a balancing act. Inflation is still above their long term target, but the labor market is clearly softening. But both of these factors will continue to influence rate decisions as we move into next year. Turning to housing, existing home closing rose a half of 1% in November, marking the third straight month of gains. This isn't a surge, but it does show steady progress and tells us buyers are still moving forward when pricing and payments make sense. That is probably what you need to tell your sellers right now. Inventory steadily declined. Inventory declined nearly 6% in October, largely due to seasonal factors, typical this time of year. This is normal heading into the holidays as sellers chose to pause their listings until the new year. Builder confidence has edged slightly higher, but builders are still dealing with higher construction costs, labor challenges, and cautious buyers. As a result, new housing supply still remains limited, which continues to support home prices in many markets. As we head into the holiday season, mortgage rate movements become less predictable. There's no repeatable formula for this time of year. Most of the time, rates drift sideways with relatively small changes. Occasionally, we see sudden dips or jumps that don't seem to have any clear explanation, largely because lighter holiday trading can exaggerate small moves. Because of this, we won't have a clear sense of where rate market really wants to settle until important economic reports resume in January. So, what does all of this mean to your buyers and sellers right now? for your buyers. Cooling inflation and a softening job market reduce pressure for rates to move sharply higher. Waiting for that perfect moment can be risky, especially when inventory remains limited. For sellers, fewer listings this time of year means serious buyers are still active, and well priced, well presented homes do continue to sell even in a more cautious market. For realtors, this is a market where education and expectation setting matter more than prediction. We're not in a boom and we're not in a crash. We're in a transition market. Inflation is easing, the labor market is cooling, housing activity is adjusting gradually rather than breaking. That stability creates opportunity for professionals who can explain options clearly and guide our clients with confidence. If you or your clients are thinking about buying, need to refinance, or just want help understanding what today's numbers mean to them, I am always happy to help. Thanks for watching this little bit longer video. Let me know what you think. See you next time on the next market update.